Alright, gang, it's your boy Nature, aka Nature. Alright, gang, so we back for another video. Alright, so today we're going to just go over patterns. I want to speed the little process up. So you're gonna see this a lot in the market. So a lot of dual candlestick patterns. Bullish engulfing, definitely. Bearish engulfing, definitely. You're definitely gonna see bullish and bearish engulfing. So let's go over the dual candlestick patterns. There's single candlestick pattern. We went over a few single candlestick patterns like inverted hammer. There's a few others that we're gonna go over too. We're gonna just go double over. I'm just gonna double over it again, so you guys can see it again on here. So all right. So dual candlestick patterns. Let's just go to it. So what's better than single candlestick patterns? Dual candlestick patterns. To identify dual Japanese candlestick patterns, you need to look for specific formations that consist of two candlesticks in total. It's two candlesticks in total, which is a dual candlestick pattern. So we have engulfing candlestick patterns, which is bullish and bearish. So for these examples, the colors are black and white. White means for y'all would be red and green. The white would be green and the black would be red. So yeah. So here is a downtrend. Here's a bullish engulfing pattern, meaning that the green or the white is bigger than the black, or would be green is bigger than the red for y'all, but the white is bigger than the white candlestick is it's called engulfing too because it's engulfing the second candlestick is engulfing the first candlestick. Same thing over here with the bearish engulfing going down, a downtrend. You see the black is engulfing the white candlestick pattern. Alright, so let's read the definition. So the bullish engulfing pattern is two candlestick reversal patterns. Up move may be coming. So when you see this, you usually see this on a downtrend or on some type of like you usually see on a downtrend. Meaning some type of it's a reversal pattern that signals a strong up move may be coming. So it's a two candlestick pattern, reversal pattern that signals a strong up move may be coming. Same thing with bearish engulfing. You usually see this at the top of an uptrend when you see a bearish engulfing. So the same thing, it happens when a bearish candle is immediately followed by a larger bullish candle. So this second engulfs the bearish candle right here. The second candle engulfs the bullish candlestick. This second candle engulfs the bearish candlestick. So this means that buyers are flexing their muscles and that there could be a strong up move after a recent downtrend or a period of consolidation. As I said, this is you usually see a bullish engulfing, which means it's going up during a downtrend, after a downtrend, a major downtrend, or after some type of consolidation. You'll see a bullish engulfing. So after a recent downtrend or a period of consolidation. On the other hand, there is a bearish engulfing pattern. So bullish engulfing means it's going up. Bearish engulfing pattern is the bullish pattern. So it means it's going down. So bearish engulfing pattern, one more time right here. You usually see on an uptrend or during some type of period of consolidation after an uptrend or some major move uptrend. And now it's consolidating, and then you see some type of you'll see this a lot, double candlestick patterns, bullish and bearish engulfing patterns. So on the other hand, the bearish engulfing pattern is different than the bullish engulfing pattern. It's the opposite of the bullish pattern. This type of candlestick pattern occurs when a bullish candle is immediately followed by a bearish candle that completely engulfs it. That sellers are overpowered the buyers, right? And that a strong move down could be happening. So it's most likely it's going to be a strong move down, and you're most likely going to see that. Like I said, let's go over. I'm going to show y'all some more examples. Of course, we have there's more double candlestick patterns to go over, and we're going to go over all of them. I just want to let's go to Let's go back up to bullish and bearish engulfing patterns. I want to just look it up of what that would look like. If I can show you some examples in the chart on MetaTrader, I will too. I just have to see if I can find it. You probably can definitely find it. You can find them all throughout. So let me just type in bullish. Yeah, I do bullish engulfing patterns. The first one that we went over was the downtrend is bullish engulfing. When you see the white candlestick during the downtrend or during the consolidation, is going up. So that's typing bullish engulfing pattern. So here we go. For you guys, is usually is green and red. So engulfing the red candlestick. So that's why it's called engulfing. And it's bullish. It means it's going up. So a bullish engulfing pattern is a candlestick pattern that forms when a small black candlestick is followed by the next day a large white candlestick, the body of which is completely overlaps or engulfs the body of the previous day candlestick. So let's see. Let's show some examples. Actually, let's go to Investopedia. Just look at everything. You know, what is a bullish engulfing pattern? Bullish engulfing pattern is a white candlestick that's closer than the previous day opening through opening lower than the previous day close. It can be identified as a small black candlestick showing a bearish trend, and the following day, a large white candlestick or green candlestick showing a bullish trend, meaning it's going back up. The trend has reversed, and the body is which is completely overlapped or engulfs the body of the previous day candlestick. So that's how you also look at it too. You have to look at the days. Like, okay, and you look on your day chart. If we look on a day chart, let's see what they're talking about real fast. Just go to MetaTrader. Okay, I don't have MetaTrader downloaded on here. Okay, I have to download it. Alright, that's the example. Maybe they have an example down here showing us that. So basically what they're saying is, the green candlestick is called a bullish engulfing only if you see the green candlestick is bigger. It's so engulfing meaning the the first candlestick would be small. It's a small candlestick, a small black candlestick, or a small red candlestick. It's going to be, I'll tell you right now, it's going to be half the size of the next candlestick. So if you see like a small black candlestick or a small red candlestick, it's not even full size of a whole candlestick. It's like it's probably going to be like 1/4, maybe half of a candle. The next candlestick, if the following next candlestick which is going to be a whole candlestick pattern, a whole candlestick is going to be a large whole candlestick. It's not going to be half or small. It's going to show that if that candlestick engulfs that small candlestick on the next day, it shows that a bullish trend, meaning that a trend going up is completely overlaps and engulfs the body of the previous day candlestick. So I just wanted y'all to know that, like, a little in depth, in case you're a little like confused. I hope that helped. So a bullish engulfing pattern may be contrast with a bearish engulfing pattern. For example, so we're gonna also talk about bearish, which means it's going down. So I just want to give y'all the key takeaways. So a bullish engulfing pattern is a candlestick pattern that forms when a small black candlestick is followed the next day by a larger white candlestick or a larger green candlestick. The bodies which completely overlap or engulfs the body of the previous day candlestick. So engulfing patterns are more likely to signal a reverse when they precede more black candlesticks. So it usually is like a signal of a reversal. So investors should look not only to the two candlesticks which form the bullish engulfing pattern, but also the preceding candlesticks. Yes, you have to look at everything. You just can't just look at Just because you see a bullish engulfing pattern, okay, it's a reversal likely, it's going back up now. No, we have to understand if that bullish engulfing pattern is like actually complete, is completely going up or not. So we have to wait, and then we make a decision. I'm gonna teach y'all how to do that, like throughout like your OnlyFans and stuff. Understanding a bullish engulfing pattern. So the bullish engulfing pattern is a two candlestick reversal pattern. The second candlestick engulfs the real body of the first one, without the regards of the length of the tail of the shadow. So remember, Merbozel, like, it's just probably like a long white Merbozel candlestick or a long green Merbozel candlestick. Remember, Merbozel means it got its name from Japanese, meaning it has a shaved head. It usually doesn't have no wicks, but you know, and it's still engulfing. That's still a bullish engulfing pattern. Like I said, it's a bullish engulfing pattern. It's two candlestick reversal pattern. So we're doing dual candlestick reversal patterns now, okay? And then we're gonna go back. I'm gonna go back and do single candlestick reversal patterns, but I want to get y'all, cause you're gonna see there's a lot, and on the chart, I'm like, what the hell is this? Yeah, these are two candlestick reversal patterns. So on the bullish engulfing pattern, I mean, it's going up. The second candlestick is completely engulfing the real body of the first candlestick, without the regards of the length or the tail of the shadows. So the pattern appears in a downtrend, and it's a combination of one dark candlestick followed by a larger green or white hollow candlestick. On the second day of the pattern, the price opens than the previous uh, lower than previous low. Yet buying pressure pushes the price up to a higher level than the previous, accumulating an obvious a win for the buyers. So this obvious is a win for the buyers. Like I said, you probably see like a small body, probably only like half a body, probably not like 1/4 of a body, and then you'll see another candlestick form after that, which is a reversal candlestick pattern. It will be engulfing. You see, it's not even half. It's about like this is half. The first body candlestick is like 1/4 the size of the whole candlestick pattern. And so it usually forms on the downtrend. You usually see this pattern on the downtrend, and when it engulfs when the second candlestick engulfs the first candlestick, that's how you know this it's a dual candlestick pattern. It's a bullish engulfing pattern, also including it's on the downtrend. Um, so that's the highest point that price went to for the day. It closed at right here at the bottom. It opened at price opened at right here because going up, so it's going to open at the low and it's going to close at the top. And then the lowest point that price went for the day, these are what the wicks are. They signify like the highest point that price went before the day before it closed, and the lowest point that price went before that day before it opened and closed and went to the highest point and closed back down. So it'll open up, and then it'll open, it'll go to the lowest point. The price will go to the lowest point for the day, go back up, open all the way up to the highest point for the day, and then close. Price will close right back down. So if price opens at the top, at the bottom, it's going up. But you have to let the candlestick patterns price do what it has to do before you actually get in a trade. I learned that from my mistakes. Take that from my mistakes, guys. So it's important to advise to enter on a long position. You want to wait to enter on a long position when the price moves higher than the second engulfing candlestick. In other words, it's a downtrend reversal is confirmed. So it's usually on. This is a downtrend reversal pattern. It's a dual candlestick pattern that you're going to see a lot. It's called a bullish engulfing pattern. I just wanted y'all to understand. What we're going to do next, we're going to do bearish engulfing pattern. All in the same video. What What does a bullish engulfing pattern tell you? A bullish engulfing pattern is not to be um, interpreted as a simple white or green candlestick representing an upward price movement following by a black candlestick representing a down price movement. For a bullish engulfing pattern to form, the stop must open at a lower price on a day then close at then on day one. If price did not gap down, then the body of the white candlestick would not have a chance to engulf the previous day of the black candlestick. So we have to wait to see if it's going to actually engulf the first candlestick pattern of the previous day, which would be the red or black candlestick. Because especially like, or it can continue going down. So if it's already going down, so if we're waiting to see, it's been going down for like the last days and months. We're waiting for like the last couple days and weeks, and now we're trying to reverse. We're waiting to see if it's going to actually reverse and if we can get a white candlestick to engulf the red candlestick or black candlestick, or if it's going to continue down. But we have to wait. So because the stock both opens lower than it did on the close on the day one, close higher than open on day one, then the white candlestick is bullish pattern represents a day where bear controlled the price of the stock in the morning, only to have bulls decisively take over by the end of the day. So yes, so bears will be selling and bulls means buying. So bulls, buyers wind up taking over price by the end of the day, which means that okay, sellers were in control of price throughout the day, and then buyers eventually were able to take control over. By the end of the day, buyers were able to take control, and the market closes at 5. So by the end of the day, the buyers were able to take over the market, engulfing the bearish trend or the downtrend. The buyers were able to take over and engulf the first candlestick that was sellers, was price that were in control. They were able to engulf that price that candlestick, and now it's a reversal that we're going back upward. So the white candlestick is a bullish engulfing pattern. Typically has a small upper wick, if any, because it doesn't have to have wicks. This means that which is wick. If you look, wicks are, we already know what wicks are, but wicks are the lines of the opening, the highest points that price went to, and the lowest points that price went to. It doesn't have to have any wicks. That means that stocks close at or near its highest price, suggesting that the day ended while the price was still surging upwards. So price ended upwards, is most likely going to continue upwards in the next day proceeding. So for us to actually get that, we have to, like, a lot of this is like real technical. Like, once you understand, like, the patterns and stuff, you'll be really able to really read price. Once, like, this is like, so the next day, price will, the white candlestick, if we have to wait to see if the next day the preceding candlestick will wants to close higher than engulfing pattern, because you could see a bullish engulfing pattern, you could see a reversal pattern and think, okay, it's going up, but we have to see if the next day, if price is going to continue going up in that direction, or if we can get a possible reversal. We can get a bullish engulfing pattern, which we're going to go. Sellers could take back control over, and we could see a black candlestick, engulfing that previous green candlestick, and we can have a continuation of a downtrend. So we have to wait, because bullish engulfing patterns tend to signify a trend reversal, but analysts pay particular attention to them. We pay very special attention to them to see if this is actually going to continue up or down. So bullish engulfing patterns versus bearish engulfing patterns. All right, so these two patterns are opposites of one another. Bearish engulfing pattern occurs after price has been going up on an uptrend, so we're going to do that next, and it indicates a lower price is about to come, a reversal is about to come. Here on the first candle in the two candlestick pattern that we just went over was an up candlestick. The second candlestick is lower than the down candlestick, with the real body engulfing the smaller candlestick, meaning that it's going back up. So alright, so let's go over um bearish engulfing candlestick now. We just went over bullish, so this is a bullish engulfing candlestick. It curves on a downtrend usually. And these two that we're going over, you're gonna see them likely. Um, they're strong, they're reversal patterns that signal a strong move may be coming up or a strong move may be coming down. So let's go to this bearish engulfing candlestick pattern. I don't want to make this video too long, so just so bearish engulfing pattern definition and tactics. So what is a bearish engulfing pattern? A bearish engulfing pattern is technically chart pattern that signifies that the pattern consists of it was going up on a white or green candlestick followed by a large down black or red candlestick that eclipses or engulfs the smaller up candlestick. So same thing that you'll see a small up candlestick, meaning that price is trying price if the price was going up but now it's the candlestick is smaller than it was the day before. So it's and then you see a large red candlestick or black candlestick engulfing that small green candlestick going up. Yeah, definitely a reversal pattern is coming up. So this pattern can be important because it shows sellers have overtaken the buys more aggressively down. So down candles, then the buyers were able to push price down, price so aggressively. They were able to push price back down aggressively, engulfing the buyers. So key takeaway pattern can occur anywhere, but it is more significant if it occurs after a price event. So after an uptrend, um, you'll see this you'll see a bearish engulfing pattern, and this could be an uptrend or a pullback. Also, a pullback. We'll have to talk about uptrends and pullbacks too. To the upside with a larger downtrend. So price can also pull back. Price won't just go all the way up. Price always pulls back. So it's once price pulls back, we wait. Well, if you don't get in, we usually wait for the pullback to get in. I don't be teaching all about that too. More, I did teach about. I already taught you about it, how to do pullbacks, and how to get in aggressively. But I'm gonna do it again. This could be an uptrend or a pullback to the upside with a larger downtrend. So when you see when you usually see this during an uptrend, or after a large uptrend, or you usually see a bearish engulfing pattern after a large pullback. So price will really pull back really. It'll be a large pullback before it pull back up. It's called a drought. So ideally, both candles are sustainably sized or around them. Two very small bars may create an engulfing pattern, but it's far significant than if both candles are large. So the real body is different than the previous body. So the real body of the down body must be engulfing the real body of the up candle. So it has to completely engulf it. So it must be. This pattern has far less significance in choppy markets. So anything like if it's consolidating, then you're it's not going to be effective. It has to be usually on an uptrend or on a pullback for bearish engulfing patterns. So bearish means is going down. It's a reversal. It's a downtrend reversal pattern. and it usually forms after a recent uptrend or a period of consolidation. So a bullish engulfing pattern right here, what does it tell you? It tells you a bullish engulfing pattern is seen at the end of some type of upward price move. It is marked by a first candle of an upward momentum being overtaken or engulfed by a larger second candle, indicating a shift towards lower price. The pattern has a greater reliability when the open price of the engulfing candle is well above the close of the first candle, and when the close of the engulfing candle is well above the open of the first candle. A much larger down candle shows more strength than if the down candle is only slightly larger than the up candle. So the valuable when it follows a clean move higher. So if price action is choppy or rangy or consolidating, then it won't be as reliable. Then many engulfing patterns will occur will occur more likely in a result of a major uptrend, you know, or a major downtrend. You'll usually see engulfing patterns, not more likely on a trend that is choppy or consolidating. Before acting on a pattern, typically traders wait for the second candle to close and then take action on the following candle. So we have to wait. So action includes, so the action that we include we have to wait to see if sellers are going on a long position, and that once we have that signal from a bearish engulfing pattern, meaning that sellers are engulfing the buyers. Once we see that pattern, we potentially will enter for a short position. We will potentially enter for a short position, and our stop loss will be above um, the last high, and we can we will look for a short position, so we can place above the high of 2 bar patterns. So for example, taking a short trade may not be wise if the uptrend is very strong. So if it's a very strong uptrend, it may not be wise, because we don't we if it's usually we usually trade on the trend. We usually don't trade against the trend. So we usually trade with the trend. It might not be wise to try to sell against an uptrend that's very strong. Even if you see a formation of a bearish engulfing pattern, it may not be enough to halt the advance for a long position, for a short position. If the overall trend is down, um, but if the overall trend is down and price has just or you have just seen a major pullback to the up from an upside, then you see a bearish engulfing pattern, it may be a good chance to enter for short opportunities, since uh, we see more of a our overall trend that's going down. Then it'll be will be likely to enter for a longer term downtrend or a long term downtrend trade. So these are examples of using a bearish engulfing pattern. All right, so let's just zoom in on this. So as you can see, for on these all these examples, every time the price wanted to go up, we see a black candlestick engulfing sellers, engulfing the buyers. Same thing here, sellers engulfing the buyers, sellers engulfing the buyers. So this will be red, and the red would be engulfing the half green doji, or 1/4 of the half green doji. As you can see, all this the black is way bigger than the first. So it's always engulfing patterns is always meaning that the second candlestick pattern, the second candlestick is always engulfing the first candlestick. So that's why it's called dual, because you're looking for two candlestick patterns to signify if it's bearish or not, if it's engulfing pattern. So It's a double candlestick pattern. So you're looking for two candlestick patterns, usually on an uptrend. I don't really like this example because it's kind of like a choppy. It's a choppy. It looks more like it's consolidating. I don't. But you see this on an uptrend or a downtrend. Um, these are examples of a bearish engulfing. I don't want y'all to get confused. We already went over bullish engulfing patterns. So this is examples of 3 bearish engulfing patterns that occur in forex market. The first bearish engulfing pattern is occurring during a pullback, okay, and to the upside within a larger downtrend. Then price proceeds lower following the pattern. Engulfing patterns are less significant. Right, they're less significant. It's more like choppy. Considering that the price is ranging the four narrow and continuing, indicating choppy trading, exactly as I just said, and there is a very little upward price movement prior to pattern forming. So a reversal pattern has little use if there is little to reverse, right? So within a range of choppy market or engulfing patterns will occur frequently but are not usually good trading signals. So you're gonna see engulfing patterns during choppy markets, and market, and that's how they get their money, because people thinking like it's engulfing. Oh, it's an engulfing pattern. Let me get in for strong buy or a strong sell, and price is in a choppy pair right now. You need to get in a different pair, find a different pair, because that pair is choppy. It's not. It signals that is consolidating and is not going nowhere. So it's useless. That engulfing pattern is useless. So the difference between a bullish engulfing pattern, between a bearish engulfing pattern against a bullish engulfing pattern, is these two patterns are opposite. A bullish engulfing pattern occurs after price moves lower and indicates higher price to come. The first candle in the two candlestick patterns is a down candle. The second candlestick is sweet. So the two patterns are opposite. The bullish engulfing pattern occurs after price moves lower, right? And it indicates higher price to come. The first candle is engulfing the first candle, and then the second candle pattern is engulfing the first candle of the high and is engulfing it on a down candle. So the second candle is larger, but if the second candlestick is larger than the up, and then the real body of the first candlestick is a small candlestick, then it's going up. Same thing. If the second candlestick is larger than the real body of the up candlestick that you just see, then it's considered that a reversal is going up, or that a reversal is going to change. So the limitations of using a bearish engulfing pattern, like I said, you're usually going to see bearish engulfing pattern on an uptrend, strong uptrend, or a major pullback, and bullish on a strong downtrend. You see a bullish, meaning it's a reversal. It's been going down for a long time now. A bullish green candlestick is reversing, wanting price to go back up. So engulfing patterns are most useful. You'll see they're very useful. So these are dual candlestick patterns. These are 6 of the dual candlestick patterns is bullish and bearish engulfing patterns. We still have some more candlestick patterns, dual candlestick patterns we gotta go over. So I just wanted to show y'all these 2 major ones, because you're gonna see these 2 major ones a lot in the market. So these patterns usually form after a shift of a momentum, after a downtrend or an uptrend. For bearish, it will be a uptrend, and for bullish, it will be a downtrend. And action is choppy, but even if price is rising, we have to see if it's going to if it's significant enough through the engulfing pattern to actually fairly come up with a signal or some type of, trade. So engulfing or second candle may also be huge. This can leave traders with a very large stop loss if they opt the trade pattern. So the potential reward from this trade may not justify a risk. So potential will be difficult with engulfing patterns as candlesticks don't provide a price target. I'm going to teach you how to like look at price target and come up with like a price target where price goes at, that's called Fibonacci. We're gonna get to Fibonacci soon, but with this we have to get over the technical stuff first. So traders will need to use other methods such as indicators, like indicators or Fibonacci. It's a lot of it's a few indicators that much. I usually just go off of just looking at price and looking at the candlestick patterns. But I'm going to teach you how to look at indicators too. Such indicators also help, like Fibonacci and moving average. Those probably the only like indicators that I use. Um, so we have to also look at the trend, see if the trend is choppy, if the trend is going up or down, and to determine if we're going to get in a trade, if the trade is going to be profitable. We want all our trades to be profitable. So, all right, gang. It's your boy Nature, aka Nature. Uh, Dual candlestick pattern. Those are the basics of bullish and bearish engulfing pattern. We're gonna talk more and more about it and get y'all more in tune with some more patterns. We got a lot more, a lot more information I got for y'all. A lot more content. All right, so gang.